Hello everyone. Today I would like to talk about bond scarcity and how this impacts investors. So it can seem strange to talk about scarcity as we all know new issues are booming. But there are changes on the maturities of those new issued bonds. According to Barclays, in the US, the amount of new bonds with a maximum maturity of 3 years has fallen by 7% in 2020. And this compares to a rise of 11% in new issues globally. Looking at yields explains this change. Yields for 10-year plus maturities have become super cheap. The average yield to maturity for investment-grade bonds in the 10-year plus segment was roughly at 3% mid-November. And this compares with an average of 4.2% over the last 5 years. So yes, it is definitely cheaper for issuers to go far on the curve. New issues with maturity up to 5 years represent only 14% of all the bonds issued so far this year. It's 3 times less than the 10 to 30-year segments, and even the 30-year plus segment is more active than the short one with a share of 20%. So this explains part of the scarcity on the short end of the curve, but only part of it. Part because issuers are also buying their short-dated bond to manage their liabilities. So there's a double effect on the short end of the yield curve. For issuer, that's great. It means more leeway to manage their balance sheet. They decrease short-term refinancing risk, and also they capture lower coupons for longer. On the flip side, the situation is not that great for conservative investors because market conditions push them to take more risk, either interest rate risk through longer maturities or credit risk through less good quality issuers. And this can be seen as a collateral effect, or let's say the price to pay for unconventional monetary policies implemented by central banks. And that could, of course, persist. We all remember back in March when liquidity disappeared, stress rose, and we all started to wonder which companies would be able to face their short-term liabilities. A lot of issuers had to draw credit lines and/or issue new debt in order to survive. So it is now not surprising that issuers do everything they can to avoid short-term refinancing risk. And they will continue as long as they don't have a post-COVID visibility. And this also means that conservative investors will have to further wait before returning to more rewarding conditions. Thank you.